Okay, let's unpack this. You know that feeling when you look at a company's earnings report
Yeah.
and it feels like trying to read a map written in like a secret code?
Huh. Definitely. Dense stuff sometimes.
Well, today we're cutting through that financial jargon. We want to give you the clearest route to understanding EVgo's Q2 2025 earnings.
Okay.
Our mission in this deep dive is to extract the most important insights, not just the raw numbers, and show you what they really mean for the company and, its future.
Exactly. And we're not just scanning headlines here. We're using a structured five-part framework
Right.
to analyze EVgo's official data right alongside what the market was expecting in real time.
And that helps us understand not just what happened, but why it matters.
Precisely. Why it led to the market's reaction and what it implies for EVgo's ongoing journey in this pretty competitive EV charging space.
Okay, great. And this framework, it'll walk us through 5 distinct slides of the analysis,
Yeah.
offering a comprehensive but hopefully digestible look at EVgo's performance. Think of it as your backstage pass to what's truly driving the story.
Let's do it.
Now for slide 1, the at-a-glance scorecard.
Okay.
The immediate takeaway here, the one that really grabbed Wall Street's attention, is that EVgo significantly outperformed revenue forecasts.
Big time.
They reported total revenue of $98.03 million for the quarter. That blew past the analyst consensus, which was around, what, $85.7 million?
Yeah, a solid beat. And the market reacted instantly. Stock price jumped over 11% right after the release.
Wow.
It's clear that for these high-growth, capital-intensive companies like EVgo, investors are still, prioritizing aggressive expansion.
Top-line growth over immediate profit.
Exactly. That initial surge was almost entirely driven by that revenue beat.
Okay.
The market was clearly focused on the accelerating growth trajectory, and it allowed investors to largely overlook some of the other, maybe less rosy aspects of the report, at least initially.
Right. But that's where our deep dive truly begins. And that brings us to what we're calling the complex story. Because while their diluted loss per share, or EPS, was perfectly in line with expectations at 10 cents,
Right on the money.
the company's net loss attributable to common shareholders actually widened by quite a bit, 25.3%.
Yeah, I went from Nanasty $10.4 million in Q2 2024 to Negasy $13.8 million this quarter.
So if the total loss got bigger, why did the loss per share stay the same? That feels like a bit of a puzzle.
It absolutely is a puzzle, and it highlights a critical point about financial reporting.
Okay.
The reason the loss per share remained flat despite a larger total net loss, well, it lies in the denominator of the EPS calculation.
A number of shares.
The number of shares outstanding, exactly. EVgo's weighted average number of Class A common shares outstanding increased by a substantial 26.4% over the year.
Wow, 26.4%.
Yeah, it grew from about 105.6 million to 133.5 million shares.
Okay, so where did those shares come from?
It's a result of their financing activities and stock-based compensation programs. So this increase in share count, it essentially diluted that larger total loss across many more shares.
Like spreading the same amount of jam thinner over more slices of toast.
Kind of, yeah. Or imagine you have a pie, and that pie represents the total loss. If you suddenly slice that same pie into 26% more pieces,
Right.
each individual slice or share looks smaller, even if the total pie itself actually got bigger.
Gotcha. So the flat EPS isn't really a sign of stable profitability at all.
Not really. It's more a result of significant shareholder dilution.
That's a really helpful analogy. So what this diluted EPS figure is telling us, despite meeting the estimates,
Yeah.
is that EVgo achieved that alongside growing total losses and ongoing shareholder dilution.
Exactly. It's a critical nuance, showing the sort of underlying cost of their rapid expansion.
Okay, moving to slide 2, the engine of profitability.
Right.
EVgo's Q2 results here, they really highlight a clear trend of improving operational efficiency, even though on a standard accounting basis, they're still not turning a profit.
Still in the red on that front.
Yeah, there's a really interesting tug of war going on between their official GAAP results.
Generally accepted accounting principles.
Right, that one. And how management wants us to view the business through their adjusted non-GAAP figures.
Yeah, it's the story of a very capital-intensive business scaling up rapidly.
So let's look at the GAAP side first.
Okay, on the GAAP side, their profitability metrics show marked improvement. Gross profit more than doubled.
Doubled. Wow.
Yeah, grew an impressive 117% year over year to $13.9 million.
Oh,
And this directly led to a significant expansion in their gross margin, which climbed to 14.2% from 9.6% in the prior year. So that's a strong indicator they're getting better at keeping profit from each dollar of revenue.
Right, getting more efficient there.
And further down the income statement, the operating loss actually narrowed a bit to Lennisum $30.8 million from Nenester $32.4 million a year ago.
Okay, still a loss, but moving the right way.
Moving the right way. And that improved the operating margin from negative or 48.6% to negative 31.4%.
Still negative, but much less so.
Exactly. And what's particularly encouraging here is how these numbers reveal the company's underlying efficiency,
How so?
Well, total revenues grew 47%, right? But key expense lines, like cost of sales, only grew 40%.
Okay.
And total operating expenses grew only 15%.
So expenses grew slower than revenue.
Precisely. This is a clear indicator of positive operating leverage. As they get bigger, their expenses aren't growing as fast as their revenue, making them more efficient.
Okay, that's the official by-the-books GAAP view, showing real progress. But management often likes to give us a different lens through these non-GAAP figures.
Right.
Focusing on operational performance, excluding certain non-cash items. Why do they do that, and what does that view tell us?
Well, from management's perspective, they want to show the underlying operational cash flow potential. So adjusted gross profit, which largely excludes depreciation, was $28.4 million. That leads to a healthy adjusted gross margin of 28.9%.
Much higher than the GAAP margin.
Much higher. But the most closely watched non-GAAP metric is adjusted EBITDA.
Right? Earnings before interest, taxes, depreciation, and amortization.
That's the one. Their adjusted EBITDA loss shrank substantially. It was just $1.9 million this quarter.
Wow, only negative $1.9 million.
Yeah, exactly. Now, while depreciation is considered a non-cash charge, meaning cash isn't physically leaving the bank for it each quarter, it represents the very real economic cost of EVgo's primary assets, their chargers, aging, and losing value over time.
It's a real expense, even if the cash wasn't spent this quarter.
Precisely. For a capital-intensive business like EVgo, that's a major ongoing operating cost.
So adjusted EBITDA is useful for?
It's definitely useful for tracking progress toward cash flow break-even and for comparing operational efficiency with peers, because everyone excludes these things differently sometimes. But investors should not ignore these excluded costs. True, sustainable profitability will only be achieved when GAAP net income turns positive.
Meaning revenues cover all the costs.
All expenses, including the very real and ongoing depreciation of their extensive network. It's really the difference between being cash flow positive operationally and being truly sustainably profitable.
Okay, next we'll explore slide 3, the engine room business segment performance. EVgo's record $98 million in quarterly revenue wasn't just luck, you said. It was the direct result of really strong growth across their main business lines.
Yep. Highlights a clever, diversified strategy.
Let's break that down.
Absolutely. So the total charging network segment remains the company's foundation. It brought in $51.8 million in revenue.
And the growth there?
Robust, 46% year-over-year growth.
Yes.
This is their core business, selling electricity to retail drivers and commercial fleets through EVgo's owned and operated public network.
And what drove that growth?
It was fueled by a significant 35% increase in network throughput, that's the total energy sold, and they impressively added over 122,000 new customer accounts in just the quarter.
Wow, 122,000 new accounts.
Yeah, it really shows powerful underlying demand and successful network expansion. They're getting people onto the platform.
But there's another segment here that reveals a particularly clever aspect of their strategy you mentioned. What about the standout performer in terms of pure growth percentage?
That would be the Extend segment. It reported $8.8 million in revenue.
Okay, smaller base.
Smaller base, but wait for it. An impressive 157% year-over-year growth.
Whoa, 157%. What exactly is Extend?
So in the Extend business, EVgo acts more like a service provider, almost an expert consultant.
Okay.
They design, build, and operate charging infrastructure for third-party partners and clients who actually own the physical assets.
So EVgo doesn't have to put up the capital for the chargers themselves in this case.
Exactly. This triple-digit growth, even from that smaller base, is strategically incredibly significant. It represents a more capital-light path to expansion.
Leveraging their expertise without draining their own cash as much.
Precisely. Allowing EVgo to generate revenue from its operational know-how without having to deploy its own balance sheet for every single news station.
That makes a lot of sense. And then there was ancillary and other.
Right, that brought in a solid $37.4 million, growing 35% year over year.
So good growth.
Yeah, it contributes to their diversified revenue base through things like regulatory credit sales and other services, kind of a mix of things.
So if we look at those different segments working together, the own network, the extend services, the ancillary stuff, what does this tell us about EVgo's overall strategy and maybe their long-term advantage?
I think it reveals a powerful two-pronged strategy, really.
Okay.
The core owned and operated network builds the EVgo brand, it expands their direct customer base, and provides invaluable data on charging behavior. It's their storefront, their direct connection to the EV driver.
Right, the visible part.
Then, the fast-growing extend service leverages that established brand and expertise into a highly scalable, less capital-intensive revenue stream.
Using the know-how gained from the core business.
Exactly. This hybrid model provides a significant potential long-term competitive advantage. It enables faster and maybe more flexible market penetration than competitors who might be focused solely on just one approach, like only owning stations or only providing services.
So they can play in different parts of the market.
Right. It allows them to participate in the growth of the EV charging market in multiple ways.
Okay. Now let's turn our attention to slide 4. Financial strength and shareholder rewards.
The balance sheet.
Yeah, this section paints a clear picture of the balance sheet for a high-growth company in a really capital-intensive industry.
Definitely.
It essentially shows a business that is, at this stage anyway, reliant on external financing to fund its expansion, still working towards generating enough cash itself.
That's precisely right. As of June 30, 2025, EVgo reported total assets of about $864.7 million
Okay.
and total liabilities of $464.1 million. But a critically important item on their balance sheet is the total stockholders' deficit.
A deficit, not equity.
A deficit of $230.1 million.
Wow. What does that mean exactly?
A deficit, as opposed to positive equity, means the company's accumulated losses over its history have actually exceeded the total capital invested by its shareholders.
So they've burned through more cash than was put in, historically speaking.
Essentially, yes. It's a clear indicator of high financial risk and a history of unprofitability. In this situation, the company is effectively funded by its creditors and through continuous new capital infusions.
Like issuing stock or taking on debt.
Right. Rather than by profits it has retained over time, because there haven't been profits to retain overall.
So metrics like debt equity don't really work here.
They become less meaningful, yeah. The key takeaway is the underlying reason. They haven't achieved sustained profitability yet, which requires those external funds to keep the growth engine running.
Okay, that stockholders' deficit really puts things into perspective.
Yeah.
So let's unpack their cash situation then. If they're not self-funding yet, how are they doing with cash flow, particularly from their core operations?
Right. EVgo's cash flow statement highlights the central dynamic of their current growth phase. They actually generated a positive $14.1 million in cash flow from operating activities this quarter.
Positive. That sounds like good news.
It is good news, and it's a significant improvement from the $7.6 million generated in the same quarter last year. It's a major milestone, really.
Showing the day-to-day business is starting to generate cash.
Exactly. The core operations are starting to generate more cash than they consume. However,
There's always a however in these reports, isn't there?
Yeah. Often, that $14.1 million isn't enough to cover the heavy investment required to expand their charging network.
The CapEx.
Right. EVgo spent $26.2 million on capital expenditures, or CapEx, during the quarter, mostly building new charging stations.
Okay, so $14 million in, $26 million out for investment.
Which creates what we call a funding gap of approximately negative $12.1 million.
They needed $12 million more than operations provided just to cover investments.
Correct. It's like building a massive highway. You're seeing more traffic, generating more tolls, which is great. But the cost of building new lanes is still outpacing those tolls you're collecting. This gap directly explains their ongoing need for external financing.
That highway analogy really clarifies the challenge. So the big question is, how do they plan to bridge that funding gap? What about strategic financing? Are they paying dividends or buying back shares?
No, definitely not paying dividends or buying back shares. Given their growth stage and current unprofitability, they're reinvesting all available capital right back into the business, build more chargers, get more customers.
So where did the money come from?
The most important development this quarter, strategically, was the announcement of a new financing agreement. In July 2025, EVgo secured a 5-year, $225 million commercial bank loan facility.
$225 million from commercial banks.
Yeah, which they described as the first of its kind in the EV charging sector.
So that's a big deal then.
It's a major de-risking event, I'd say. It provides a substantial runway of capital.
To fund that gap we talked about.
Exactly. To fund that funding gap and accelerate the build-out of over 1,500 new fast-charging stalls.
Okay.
And crucially, by using debt financing instead of issuing new stock.
Relates back to the dilution point.
Right. The company avoids immediate, large-scale dilution for existing shareholders, which we saw the impact of earlier with that flat EPS figure.
So debt instead of more shares.
Plus, this move also serves as a strong vote of confidence from commercial lenders, in the viability of EVgo's assets and their long-term business model. These banks wouldn't lend $225 million if they didn't see a path forward.
Good point. What's the downside of taking on that much debt?
Well, the obvious downside is that it increases the company's financial leverage, meaning more debt relative to its assets or future equity, and it will result in higher interest expenses going forward.
Another cost to cover on the path to profitability.
Exactly. Adds another line item to their profitability journey.
Okay, finally, let's dive into slide 5, the Roadhead Management's outlook and key takeaways.
I'll pick it up.
Management's commentary and their updated financial guidance, they seem to project a lot of confidence, right? That the company's operational momentum will continue.
Yeah, they sound pretty optimistic, potentially putting key profitability targets within reach for the full year.
What did the CEO say?
CEO Badar Khan stated in the earnings release, and I'm quoting here, "As we look to the second half of the year, we remain fully focused on shareholder value creation by continuing to improve profitability and build on our financial momentum to move closer to our goal of achieving adjusted EBITDA breakeven for the full year."
Okay, aiming for that adjusted EBITDA break-even for the full year 2025.
That seems to be the key internal target they're stressing. And to back this up, EVgo updated its full-year financial guidance.
What's new range?
They're now projecting total revenue between $350 million and $380 million for the full year.
Okay.
And adjusted EBITDA between negative $5 million and positive $10 million.
So the range actually includes positive territory now.
Exactly. And that was viewed very favorably by analysts, by providing a range for adjusted EBITDA that includes being profitable on that metric.
Management is signaling a strong belief that their operational improvements are on track.
Right. On track to hit a major financial inflection point before the end of the year, at least by that adjusted measure.
Okay. So if we had to summarize the key takeaways from this whole deep dive for you, our listener, what are the most important insights in this quarter's report? Let's boil it down.
Okay, 4 key things stand out for me. First, revenue growth steals the show.
The big beat.
Yeah. That massive revenue beat of over 15% was the dominant story. Powerful top-line performance, accelerating market adoption. Hard to argue with that.
Okay, number 2.
Second, profitability is a tale of two metrics. We talked about this a lot. While that non-GAAP adjusted EBITDA break-even is approaching rapidly,
Right.
significant JAP-level losses persist, and that really highlights the immense capital costs inherent in building and maintaining a nationwide charging network. Depreciation is real.
Got it. Third takeaway.
Third, we saw the hidden cost of growth. Remember that flat Natazar 10 EPS?
Yep, met estimates, but
But it wasn't a sign of stable profitability. It was an accounting outcome made possible only by that huge 26.4% increase in the share count. It just underscores the ongoing shareholder dilution needed to fund their aggressive expansion.
a cost investors need to be aware of. And fourth,
Strategic financing unlocks the future. That new $225 million loan facility is maybe the most critical strategic development this quarter.
why so critical?
Well, it provides a vital capital runway to keep building the network, it validates the business model to commercial lenders, and it accomplishes this with less immediate dilution than just selling more stock would have caused. It buys them time and credibility.
Okay, that's a great summary. Revenue growth, the GAAP versus non-GAAP story, dilution, and the key financing deal.
Yeah, I think EVgo's second quarter was really a testament to its growth engine. Delivering that powerful revenue performance definitely commanded the market's attention.
They proved they can expand, attract customers, execute that diversified strategy.
Right, leading to results that significantly outpaced expectations. And this operational success, crowned by that landmark financing deal securing their near-term future, well, it painted a compelling picture of a company gaining momentum.
But here's the big question for you, the listener, to consider. Can the company leverage this impressive growth and this newfound capital to achieve the scale and efficiency needed to deliver true, sustainable profitability? That positive GAAP net income.
That's the billion-dollar question, isn't it?
It really is. This quarter was definitely a decisive and encouraging step forward. It provided a much-needed capital runway and market validation.
No doubt.
But the journey to convert that top-line velocity, that impressive sales growth, into bottom-line victory, that remains the central challenge that will define EVgo's long-term success. Please remember, this report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional.
Absolutely. Do your own homework.
Also, this report was generated by an artificial intelligence model. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by you before making any decisions.
Double-check everything.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.